Hey everybody, Marty Missouri, good evening. November 20th, 2018. Been with me on the videos. We started this a few weeks ago when the market was beginning to stage its second correction of 10% on the year. And right in here, we had our first conversation. It looked like the market was trying to bottom here, and we had a nice 3 or 4 day rally. I was suggesting then, based on this one basic indicator on balance volume, that we shouldn't be too confident that that was going to stick, that it looked to me like the internals were suggesting a test, possibly a breach of that support level. Sure enough, we came down and tested it. You might say the folks who maybe got worried because they didn't buy this bounce, saw it come back down to that level and said, okay, let's go ahead and get in because maybe we're going to ascend back to new all-time highs. That lasted all of one day, came back down, tried to rise back above that, but the selling persisted, and we came in here and set a new intraday bottom at about 24,162 on the Dow. Bounced off of that pretty substantially. It was beginning to look better, and then it began to fall apart here, as I said in the last video, on some negative commentary around the trade deal or the potential trade deal with China. And right in here, the market was beginning to bounce a little bit, as no doubt folks who didn't buy here and maybe regretted it thought, okay, if we get back to here, it'll be another chance. So here we had 3-4 days or so of support. But as I suggested back here when we did a video on the 15th, the same basic technical indicator suggested that probabilities did not favor a strong bounce and a big move up to beyond these all-time highs. That it looked like there was a good chance that we would probably breach that and then come back and test these levels. Well, we didn't quite do that today. We had two real ugly days in the market, this one and then this one. Not quite a test here. The market closed a bit off of the intraday low, which was a bit above this support level here. And I'll say it again, wouldn't surprise me a bit to see a test here. Whether or not we bounce off of that will be the news around that, but certainly I expect some buying coming in here. There are going to be folks who think that this might be a legitimate bottom. This is another chance to buy at that lower support level. If we don't get some good positive news, and I think the big news is going to be about trade, ultimately with that, then a good chance that we come down and break this level. And then other support levels would be, for example, right about here. Ironically, right on about 24,000 on the Dow. I would expect a little buying in there. If we get down below that, then there's this real serious support level right in here that takes us all the way back to the bottom of that first correction that began on January 26th of this year, and that would be about 23.5 on the Dow. Folks, none of this actually means that we're in a bear market, that we're going to have a bear market, that this is time to begin worrying about a bear market. By definition, if we're right about our macro assessment, this is volatility. Might even say extreme volatility within the context of an ongoing long-term bull market. Only when our data says that odds going forward favor a contraction more than they favor a continued expansion do we really need to begin having that bear market conversation. A weak stock market against some of the backdrop, some of the other global concerns that are out there, a lot of them geopolitical, could indeed cause a situation where conditions roll over. We're just not there at this point. And we learned over the years that we do not want to act aggressively. Now, we might incrementally get defensive. We certainly have a different target allocation. At the beginning of 2017, we had a target of 18% tech. Now we've got that in most portfolios down to 10, 12, maybe 13, 14, depending perhaps on the idiosyncrasies of a certain portfolio, client, tax conditions, and so forth. We might have 14, 15% technology, but for the most part, we're trying to keep our portfolios closer to 10 to 12 right now. So we definitely have done something that would, in many people's eyes, would be viewed defensive, but it's simply because we think that going forward, the setup in terms of the stage of the economic cycle, where technology has been, where spending and investment we think should be going forward, really begins to favor things like materials and industrials and financials. So I wouldn't say that's getting defensive. I would just say that's becoming more consistent with what conditions dictate. Also, though, we do have a higher target now to things like healthcare and consumer defensive stocks, and that is a defensive at the margin move, and it's also because these things technically have been looking pretty attractive as well. But not a wholesale move to the defensive posture, because right now, as I'm repeating, general conditions suggest that odds still favor continued expansion and a continuation of the bull market. I've expressed my personal concerns ad nauseum, I'd have to say, here on the blog, all the way back to my end of last year, beginning of this year letter, where we had a very bullish macro backdrop. We had the highest score ever with our PWA macro index. And so the setup was very good for a very good year. And I said then, and I said several times, even before the big tariff attack even began, that the one thing that really gets in the way of that bullish thesis, or the way I said it was, the one thing that's going to put that bullish thesis to the test would be protectionism. And that's exactly what we're dealing here with right here. And I know people would say, among other things, like a tightening Fed, housing beginning to roll over a bit, other concerns that I think we should be paying very close attention to, many of which are just part and parcel to where I think we are in the cycle. I think it's too easy to take our eye off the ball and start talking about the Fed and these other things, when in reality, there's this one big thing that if we can get that out of the way, then we can get back to talking about market dynamics within the context of an economic cycle. Right now, this creates a lot of noise, a lot of volatility, perhaps opportunities for folks who have some cash, if and when we come to terms with this big issue that the government is currently dealing with. So folks, what I'm doing here is just making you aware that there's always a lot of uncertainty in the markets. If it weren't the issue that I keep talking about, perhaps it would be something else that would be creating this correction. Generally, corrections are good things. They clean up a few excesses that are building in the market. They tend to be healthy when they happen periodically throughout bull markets, which they always do. Right now, this is how we view this one. Not because that's our bias, not because we want that to be the case, not at all. It's actually simply that's what general conditions currently dictate. Thank you as always for watching and listening, and of course I'll be back very soon. Take care. Bye-bye.